Welcome back. Friday here on Squawk Cage. You're back with Kathy Matsui, Goldman Sachs Japan, still with us from our studios up in Tokyo, along with our bureau chief there, Kaori Enjoji. He's just left off talking about how, look, if Abenomics manages to push Japan, forget the 2% target, but just out of deflation, that's going to be a good thing. And there's a slew of very broad wash of companies and sectors that are going to be able to benefit from this. This is assuming, Kathy, that they have pricing power. How do you see things evolving on the other side? That is, spending. You know, unions are probably the happiest they've been in decades, but you know, we need to see wages going up for everybody across the board, so they have more money in their pockets, so that once they get this idea in their heads that, okay, deflation is not going to continue, we're going to get inflation, things are going to get more expensive tomorrow, I better buy today. That's got to happen too.
Yeah, so absolutely. I mean, I think that the focus so far, at least in the stock market, has been, you know, what is the Bank of Japan going to do to crack deflation? And we all know that while a bold stance from the central bank is a very critical component of exiting Japan from deflation, a very critical other component, of course, is what is going to happen to the paychecks of normal Japanese households, which, frankly speaking, despite the long-term uptrend in labor productivity in this country, nominal wages have been going in completely the opposite direction. So, but first things first, we need to get corporate Japan out of a sort of a comatose state, get the patient walking again. As I said before, I think profits are probably going to close to double. As profits experience a sharp recovery, then there's frankly little excuse for corporates in Japan not to share some of the fruits of that recovery with the worker community. You have seen anecdotal evidence from the biggest car companies, from the biggest retailers, actually starting with bonuses. You're right, it's not widespread yet, but I think give it another year. If we can hold even this sort of 90 yen dollar rate by this time next year, I bet you that the next spring wage negotiations will show a more wider spread swath of companies that are willing to pay their workers a little bit more.
Yeah, let's hope they have some success with working out some of these structural challenges ahead of them. Kathy, let me ask you your investment advice. We had a gentleman on the show, Nick Smith from CLSA, about a week ago, and he said when a market turns like this, like what we are seeing with the Nikkei, you've got to get your hands dirty to make money. Forget about blue chips, focus in on the companies that got absolutely hammered during the downturn. Would you agree with that approach?
Yeah, well, I think the nice thing about looking at Japan today is, frankly, if you look at the entire market, not just the mega caps, but also the small mid-cap universe, everything is pretty cheap. So let's take the TSE1, the whole topics. Back in the Koizumi rally, 2003-2006, the percentage of Japanese companies that were trading below book value was only 11%. The price-to-book multiple was 2.3 times. Look at today, the percentage of companies, even after this 55% surge in the market, trading below book value is still about 1/2 of the market, 1/2. And the price-to-book multiple, as you know, is about 1.3 times. So the good news is there's a lot of things to choose from. If you're really a value investor, you can go for deep value names, especially in the small mid-cap space. If you're just nervous or concerned about liquidity constraints, there's plenty to choose from also in the larger cap space as well. So if you want high yield, if you want medium yield, if you want higher growth, medium growth, there's a lot of things, I think, to choose for. Now, I would say, however, just to be balanced, I do not like, for example, exporters that are globally uncompetitive to begin with. I think there's still a lot of excess capacity in certain parts of the export space here, and those are areas that I think just because the yen has risen doesn't mean they're wholly completely competitive again. I think we have to be a bit careful about taking an indiscriminate view across the whole broad universe of export companies.
This bomb that Mr. Kuroda sort of dropped on us last week, it's been a week, seems to have caused a lot of confusion, particularly in the JGB market. And he seems to be calling in a lot of foreign institutional investors. I understand he had a meeting with them yesterday to try and explain and maybe even tone down the market's interpretation of what he actually tried to do on Thursday. Did we get too excited about what he did last week?
No, you know, we had a couple of questions on this ourselves, and a lot of people are asking us about some of the jitteriness that you're noticing in the JGB market since that announcement last week. But if you think about it, I mean, what he has done is sort of ripped up the rule book and come out with a completely new framework of how they're going to do their monetary policy operations. And when you do such a dramatic shift in the regime, in the framework, there's bound to be some transitional sort of teething issues. And I think that's exactly what you're seeing in the bond market today. I think perhaps one of the issues is communication. Maybe they need to communicate a little bit better with the market participants just to more precisely explain sort of this is how mechanically it's going to work, et cetera, et cetera. But in our view, we do not believe that this is going to escalate into something that's going to destabilize the JGB market. We do not think that there's a fiscal crisis that's going to cause the bond market to collapse anytime soon, but probably will take a few more weeks before all of these sort of mechanical kinks can be ironed out from the JGB system.
Kathy, hi, this is Adam in Singapore. I want to extend that talk about the JGB market and, of course, the reaction for the banks. So let's face it, the banks hold just huge amounts of that paper, and they're going to benefit, obviously, from the results because the JGB market has gone ballistic. They also hold a lot of equities within their portfolios. But this campaign to reduce the yen rates and also the interest rates, isn't that going to hit the NIMs of the banks, and does that necessarily mean that we're going to see some credit growth throughout these financial institutions?
You're right. I mean, the lower rates go, the lower NIMs become for these institutions on the one hand. However, a couple of comments I'd make. First, if you look at the what is the whole aim of what the Bank of Japan is trying to do? It is trying to sort of unlock and unleash animal spirits. It's trying to get companies, not so much big companies who do have a lot of cash on hand, but more the small, medium-sized enterprise universe, which probably doesn't have enough cash and just doesn't have the confidence to go and invest and spend. So that's, I think, the whole aim of this program. So if that is even marginally successful, my guess is that domestic credit growth, which has really been kind of flat as a pancake or negative, which has just recently begun to hit positive territory, that may pick up, number one. And number two is, remember, Japanese banks, especially after the global financial crisis, went very aggressively into the overseas lending markets, especially taking up or filling that vacuum that European banks in many parts, for example, in Asia, had left to fill. So interestingly, for some of the mega banks, overseas lending is now about 20% of, or probably going to approach 20% of total loans, and those NIMs are presumably a lot fatter than what they're going to get at home.
Okay, could be offset to slimmer NIMs at home. Kathy, great to talk. You got to go.